Okay, so what it says here, becoming a high net worth trader. That is something that a lot of people don't understand how to get to that point. A lot of people think the best road is to do that by using prop firms, by literally just throwing all their money into prop firms, FTMO, whatever. I'm here to tell you that's not the case. There's a really easy plan to actually get to a high net worth trader, although it's not what a lot of people think. So let me first explain prop firms real quick. Prop firms like FTMO, they make money when you fail. What does that mean? That means they're not your friend. They will offer you an X amount of money if you do pass their challenge, but they make it as difficult as possible. The statistics show around 20 to 25% get fund, or 20 to 25% actually pass phase one. And then from that 20 to 25%, only 30 to 35% actually pass phase two. If you got 1,000 people, there's going to be, let me type that out. You got 1,000 people, there's going to be around 75 people that actually get funded. From that 75, there's only going to be between 5 to 10 people that actually get a payout or multiple payouts. So very little people actually make money from prop firms. Not to say that it's a bad ROI, because if you do make money from prop firms, you're on the right track. And I should add that those numbers, those statistics by FTMO, where it says that only 75 people get funded, meaning that the majority fail, they are a little bit skewed because there's a lot of people trading prop firms who aren't even using a stop loss. Over 40% of people who are trading prop firms are not even using a stop loss. So it's a little bit messed up, that view, but still. This is the approach that a lot of people take. Now, the issue is once you do get funded and you get a payout, the average payout is around 5K. You get a payout. A big part of that goes to taxes because it's taxed as income, not as putting your own money on the line. So it gets taxed pretty high. Let's say you're paying around 1.5K in taxes. You're left with 3.5K. The issue is this is a good thing, but how much time did that take you? Did that take you a month, 2 months, 3 months, 4 months? Well, the reality is that the majority of people spend over 3 to 4 months to get to that point. Now, becoming a high net worth trader means utilizing your time efficiently. What does that mean? That means not wasting too much time on prop firms, not spending months and months and months on end on prop firms, because they are ultimately a good ROI, but they are also something that is very time consuming. So how do you become a high net worth trader? You make a plan to use all the methods available. And there's 3 methods here that I'm going to name. All methods available to increase your net worth as a trader. The number one thing that we need, though, is a source of income. And that source at the beginning is not going to come from trading. Why? Well, if you're growing your account and you're taking money out of your trading account, then you're ruining what is called the compounding effect, which is literally just interest on top of interest, or returns on top of returns. If you're making 100K and you make 10%, you're now at 110K. If you make 10% again, you're not making 10K, but you're making 11K. So you're at 121K. You make 10% on that. You're now making more and more and more. That's compound interest, or compounding your account. So you cannot withdraw the money from your account, because in doing so, you ruin the concept of compounding. So you need a salary, something that makes money. That's your number one thing as a high net worth trader. Then you've got a couple of ways. Let's say you got around 750 euros of free margin, or dollars, free margin every month to spend on growing your net worth as a trader. The number one thing, which actually doesn't have too much to do with trading, is investing in mutual funds, ETFs. Very simple. Why? Well, it's going to make sure that you net between 10 to 12% a year. So that is 10 to 12% a year. That does not really require any effort. A third of that, or maybe a fourth, whatever you're comfortable with, should go to ETFs. So for example, let's say 250 goes to ETFs. Then the second thing is prop firms. We're going to name that PF. Prop firms should be a part of your salary. Okay, so, or the free margin that you have. So let's say we do around $300, maybe 250 as well. Let's do 50 to make it easy. $250 that go into prop firms. What does that net you? That gives you around 3 10K accounts. So every month you are able to pass or take 3 10K challenges. And the third one should be a personal account, PA. And should put the last 250 towards your personal account. Why is this the best approach for it? Well, you're guaranteeing, or not guaranteeing because nothing's guaranteed obviously, but you're making sure that there's a high chance that you're making at least 10 to 12% returns per year on an X amount of money. Also, you're providing yourself with a continuous plan of challenges. We also know, for example, that the majority of people do not buy one challenge and get funded and make a ton of money. No, it takes multiple challenges. So in pretty much buying 3 to 4 challenges a month or setting a budget for those challenges every single month, you're really letting the odds play out. It's only a matter of time, if you are obviously profitable, before you get funded using this method. And then a personal account, you're also growing your personal account in the meantime. You're trading on a personal account. Let's say you got a 10K personal account, got a 10K challenge. You're depositing $250 a month into this. At the end of the year, if you make, for example, 30%, you're up 13, or you're at 13K, but you've also been depositing $250 every month. So that's another 3K. You're at 16K at the end of the year. Also, you have done 12 times 3 challenges. That is 36 challenges in a year. Well, if you don't pass a 10K account within 36 tries, you're definitely doing something wrong. So 36, well, let's say you pass around 6 or 7 or 8 of them, maybe more, maybe less, doesn't really matter. At least a bunch of challenges. Your total capital in terms of trading at the end of the year should be around 30 to 50K. And that is what you have to trade with. In the meantime, you're also making returns on something that you haven't really had to look back on, which is a simple mutual fund portfolio, an ETF portfolio that's really just netting you 10 to 12% without really putting in any effort. And you're growing or compounding your personal account by literally just trading, and you're taking the same trades here that you are taking here. Now, the reason why so many people never get funded or never get to the point of being a high net worth trader is because they focus on just one of these things. They're either like, I'm going to go all in on getting funded and then spend months and months on end trying to make it with prop firms. And then they spend so much time only to pass a 10 or 20K account, get 1 or 2 payouts, blow it, etc. Or they spend all their time and money on growing a mutual fund portfolio, which I don't think is too bad of an idea. But barely anyone does all these 3 things intertwined, all these 3 things at the same time. Doing these 3 things at the same time, if you are a profitable trader, which is obviously really, really important, is going to make you a high net worth trader. If you do this exact approach with $750 a month, $1,000 a month, $1,500 a month, whatever amount per month, for 10 years, you are going to become a high net worth trader. Even if you're only netting 25, 30 R per year, you're still going to become a high net worth trader by using this approach. Like I said, the issue is majority of people put all their hopes on number 2, just spending all their money on prop firms and then getting funded, getting 1 or 2 payouts after spending a couple thousand on prop firms, and then after that, blowing the account, getting emotional, trying again, etc., etc., etc. A couple of things that you need to understand about prop firms too. You don't have the compounding effect. You're taxed at it at a high rate. And at the end of the day, these companies are here to make you fail. They are not your friends. They want you to fail. That's how they make money. So don't believe in all the bullshit that you see that they are here to offer you an X amount of money and give you large accounts. They make money when you fail. So that is their business model. That is what they're set out to do. And what they want you is, or what they want you to do is they want you to spend as much money on them and have this idea in your head that they are the holy grail and they are pretty much the people that are going to make you profitable and make you a lot of money, and they're going to give you 100K in capital. Let me tell you right now, 10K personal capital is worth a billion times more than 100K in funding capital or funded capital. That is so important to understand. So please do not neglect that. That's pretty much what I wanted to talk about for now, real quick. I think that this is really important, and people should really consider this a lot more and think about this a lot more, because it is so important to understand. So I'm not gonna keep you guys here for too long. It's important to think about it, utilize it, and do something with it.